Did you know that in October 1981, the average 30-year fixed mortgage rate in the United States reached an all-time high of 18.63%? Yet, despite these staggering rates, people continue to purchase homes. Fast forward today, while the current mortgage rates are significantly lower than the peaks of the early 80s, many potential buyers are hesitant. They're wondering, should I wait for rates to drop? Here's the unvarnished truth. Waiting could cost you thousands, and I'm going to show you why. Stay with me, because by the end of this video, you'll have the insights you need to make the smartest decision for your future. Not just for today, but for the long haul. I get it. You want to lock in the lowest possible interest rate. Nobody wants to overpay, and waiting feels like the safer move. But here's what most people just don't consider. You're not just waiting for rates to drop. You're competing against every other buyer who's waiting for that too. And when that day comes, home prices will surge. Demand will skyrocket. Suddenly, that better rate won't matter because homes will be even more expensive. Consider this. In the early 2000s, the U.S. experienced a housing boom fueled by low mortgage rates and a surge in speculative buying. When rates eventually rose, many who had waited found themselves priced out of the market as home prices escalated beyond their reach. The moment mortgage rates dip, buyers flood the market. It is like a Black Friday sale, except the discounts never come. Instead, bidding wars break out, sellers raise their price, homes that were sitting on the market for months, gone overnight. And those waiting for the perfect moment, they're now paying way more for the exact same house. Sometimes tens of thousands more. Still think waiting is a good idea? The reality is, affordability isn't just about interest rates. Home price appreciation plays a huge role in what you'll ultimately pay. The National Association of Realtors reports that home prices in the U.S. have increased by an average of 4.6% annually over the past 50 years. That means waiting even a year could mean paying significantly more for the exact same home, even if rates dip slightly. Let's talk about what actually drives mortgage rates. It's not just the Federal Reserve pulling the levers behind the scenes. Rates are influenced by a myriad of factors, including inflation. When inflation rises, lenders demand higher interest rates to compensate for the decreased purchasing power of future repayments. Economic growth. Strong economic growth can lead to higher income and increased demands for mortgages, pushing mortgage rates up. The Federal Reserve policies. While the Federal Reserve doesn't set the mortgage rates directly, its policies can influence the broader economy, which in turn, it affects mortgage rates. Global events, geopolitical tensions, pandemics, and other global events can lead to economic uncertainty, causing rates to fluctuate. Waiting for rates to drop is like waiting for the stock market to crash so you can buy low. Sounds great in theory, until you realize you're gambling with your future. Let's do the math. If you're looking at a $400,000 home today and you decide to wait, hoping for rates to drop, consider this. Even if rates decrease, increased demand can drive home prices up. A modest 10% increase means that that same home now costs you $440,000. That's an extra $40,000 you now have to finance. Even if you secure a slightly lower interest rate, you're still paying more overall due to the higher principal. Let me share a Kevin Martini example for illustration. If you buy a $400,000 house at a 7% rate, your monthly principal and interest is about $2,661. If the rate drops to 6%, but the price jumps to $440,000, your payment is now $2,638. A small difference, right? But over 30 years, you pay nearly $20,000 more in total cost by waiting. The smart move. Buy when you're financially ready, not when rates look perfect. So what's the best approach? Get in now and refinance later. Here's why. You build equity sooner. Every month you wait is a month you're paying someone else's mortgage instead of your own. You lock in today's home prices. No risk of paying more when the market surge. You can always refi when the rates drop, but you can't go back in time and buy at today's prices. Your hedge against inflation, real estate, has historically been one of the best hedges against inflation, meaning the value of your home is likely to rise over time. Real estate isn't just about getting the lowest rate. It's about getting in at the right time. And for many people, that time is now. If you take one thing away from this video, let it be this. The best time to buy a home isn't when the rates are perfect. It's when you are ready. Don't let fear or headlines hold you back from building your future. Want help figuring out if now's the right time for you? Send me a message and book a free strategy call. You'll walk away with the numbers and there'll be no pressure, no sales pitch. Just real advice that puts you in control of your home buying journey. Remember this, homeownership isn't just a dream, it's a strategy. And with the right strategy together, we can make it actually happen.